Food. We all have to have it. We gotta survive. And wouldn't it be nice if we could write off all the meals that we had as a business expense? Well, if you listen to a lot of TikTok and social media gurus, they'll tell you just that. Hey, do this, you can write off all your meal expenses. Get a personal chef. It's a business expense as long as you're talking business. Well, let's go in and debunk some of those myths and look at the actual tax law that deals with the deductibility of meal expenses and how you can actually substantiate your meal expenses so that they are deductible and defensible in an IRS audit. For those of you that don't know me, I'm Dave Lewis. I'm a certified public accountant and the owner of High Impact CPA. We help small business owners maximize their profits and cash flow and pay the least amount of taxes legally possible. So today I wanted to just jump in, do a deep dive on the deductibility of meals, and more importantly, what isn't deductible, because this is where most of the information is coming from out in the ecosystem. So again, if you go to TikTok, if you're scrolling through and you see someone with a fancy Rolex going, hey, I write off all my meals, one, that should probably be a red flag for you. And two, the question should come to your mind, well, you think the IRS would have thought about that, or the people that wrote the laws thought about that? Well, you're right. There are a very strict set of rules and years of tax law and court cases, treasury regs that deal with the deductibility of meals. So let's jump right into it. And the first thing I want to start with is actually what's not deductible. And I want to go over the point that there's a lot more nuance to this than you might think. You've got a couple of hurdles to get over before you're actually able to deduct your meals on your tax return. So, first is it an ordinary and necessary business expense? This is the hurdle that all deductible expenses go through for. So, if you're running a business, you have to prove that the expenses that you're incurring that you're deducting are ordinary in the course of running your trade or business, and they're necessary as well. So I can't just go out and buy whatever I want and say it's a business expense, right? There is the matter of facts and circumstances within your business that is going to determine whether or not something is deductible. And with meals, there's a lot of other hurdles you have to go through. So one, is it lumped in with entertainment? So with the Tax Cuts and Jobs Act in 2017, and this is extended with the One Big Beautiful Bill Act, entertainment expenses are no longer deductible. And so you might go out, take potential clients out to a ball game, right? And unless the food that you're paying for them is broken out separately, it's considered part of entertainment. It's non-deductible. So that comes into the record keeping bit we'll talk about later in this. Another thing, is it lavish or extravagant? If you're going out and you're having a $2,000 meal and that's you know very out of the ordinary for you, it's probably not deductible. Is it treated as employee compensation? There are different rules for that if you are paying for meals for your employees and it's going to be included as income to them. So we'll talk about that as well. Same thing, there's also extra threads around travel, and these are just a few examples of the nuances that are out there. There are a ton more. My point that I'm trying to get across is that it's not as simple as, okay, I had a meal, I'm doing it in the course of my business, it must be deductible. Not always the case. So, most importantly, let's talk about what isn't deductible because these are the most common mistakes that I see business owners making. Your daily coffee run on your way to the office, it's not deductible. Same thing with casually grabbing a meal at McDonald's, Arby's, your regular lunch is not deductible, even if it's in the course of business. So, okay, say you're a real estate agent and you're running from one client to the other, you're showing houses and you need to get some food in between the showings, what have you. Well, not deductible. It's not a business expense, really. You're having a personal meal. Another big example, huge mistake that I see is, okay, you go out to a meal with your spouse, you're both owners in the business, you might have, different roles, responsibilities, and hey, you're talking business at lunch, must be deductible, right? No, It's not. There's still other obstacles you have to overcome in order for it to be deductible. And we kind of touched on this a little bit earlier, but meals at entertainment events that aren't broken out, not deductible anymore. So the most important takeaway that I want you to get from this presentation is that just because you're talking business or you think a meal has to do with your business does not necessarily make it deductible. The actual crux of the argument is whether the meal is different from or in excess of that which would have been made for taxpayers' personal uses. So, um, if you're going out and meeting with a client, say you're trying to win their business, you have a nice meal, not extravagant or or lavish, but a nicer meal than you normally would because you're trying to win the business. That's a good example of a deductible meal because you're actively trying to win that business. You might not otherwise have won the business if you don't wine and dine the client, and it's in excess of, say, what you would have, for example, you pack a peanut butter and jelly sandwich for lunch, right? It goes a little above and beyond. And a good example of this is if you look at these two court cases that I've laid out here. So Sutter v. Commissioner and Moss v. Commissioner. The Sutter rule has long been held as one of the baselines in how business deductibility of meals is going to be determined just because of what I mentioned. There's that excess that is beyond personal purposes. Now, in Sutter v. Commissioner, the tax court found that there's a presumptive non deductibility of personal expenses. And that has held true in perpetuity for basically says that your personal expenses are not deductible as a business expense. And there is a presumption that things like eating is an inherently personal expense. So that's where the different hurdles come from that you have to meet. Moss v. Commissioner, very similar thing. So this was an attorney who would meet with his team every day for lunch to discuss cases. And while that seems like business purpose on the surface, and it is, I mean, they're talking about cases, it should be by all means a business expense. But because of the frequency, how often they were going out to lunch and having a meal, it was deemed a personal expense. So frequency matters, excess matters, all these different things matter in determining whether or not a meal is deductible. So as of now, with the Tax Cuts and Jobs Act, and before it's changed a little bit, the One Big Beautiful Bill, we'll talk about a few things that changed there, but there's basically two levels of deductibility for meal expenses. You have your 50% meal deduction, where you pay for something, you get to write off 50%. And then you've got 100% deductible, which has a different set of rules where you get to write off 100% of the meal deduction. So the most common is 50%. The exceptions are the 100% rule, and we'll talk about that. But we're going to go down. I know people hate reading slides, but 50% is the most common. First of all, you have to hit that ordinary necessary business expense piece, right? It has to be in the course of your trade or business, has to be paid or incurred in the taxable year that you're carrying on that trade or business. So basically matters for the timing of the deduction, right? If I paid for a meal in 2025, I get to take that deduction in 2025. It's not lavish or extravagant based on the circumstances. Now, this is where a lot of the TikTok gurus go wrong because they will read a section of the Internal Revenue Code and go, that's it, man. Straight line. We're drawing a line in the sand. It must be deductible because this provision of the code says so. But that's ignoring a whole bunch of other tax law underneath it. So treasury regulations, tax court cases that look at the actual facts and circumstances that underpin what's going on. Like, why was it actually deductible? So if someone gives you an absolute about anything regarding tax law, this is just a good rule of thumb, you should probably ignore that advice. The rest of it, business owner, employee is present at the meal. The meal is provided to a current or potential customer, client, consultant, or similar business contact. So we still have to make it for a business purpose for it to be deductible in your business. But those facts and circumstances have to show that it's gone beyond personal use. So I'll give you a couple examples here. So say taxpayer A takes a client out to lunch, foster their business relationship. That's the first example I gave. We talked about that earlier. Business owner can deduct 50% of the food or beverage expense. So essentially, think of it as the amount you're paying for the other person. So taxpayer B takes a vendor out to dinner, discusses a new contract. Same thing. You're talking with a vendor, you're trying to get, reasonable terms, comparing them against other vendors, and you want to court them a little bit. Great. Deductible meal expense makes sense. Taxpayer C attends a business seminar where meals are provided. Here's where it gets a little weird because technically, unless the meal is broken out, you can't deduct the 50%. It's kind of falls along the same lines as entertainment. It's a little bit different, but if you are going out to like a training event, something, see if you can get that meal broken out as part of the cost. If they do an itemized statement, great. If not, you might have to do it yourself and go, well, hey, here's what the value of the meal would have been in this case. Another one, taxpayer D provides foods to employees for the convenience of the employer. These costs would fall under 50% deductibility. So say you've got a cafeteria on site and you pay for the employees' meals. 50% deductible. Now, this is a big change that the One Big Beautiful Bill Act has for 2026. This is going away. And there's a quick slide at the very end of the presentation, but um, it's it's one of those things that was hidden in there that not a lot of business owners saw or understood. So if you were providing meals for the benefit of your employees, there's some other things we need to look at to see if we can make it deductible under different rules. But on the surface, this is going away in 2026. One other example, if you've got meal reimbursements that you provide to employees under an accountable plan, I'm not going to go into what an accountable plan is in detail in this presentation, but just know there's accountable plan versus non-accountable plan. In an accountable plan, the reimbursements you give to your employees, you don't have to include in their income. Under a non-accountable plan, you would include it in their income. So, topic for another day. Now, 100% meal deductions. Same substantiation, there's different criteria to make it fully deductible. So, things like meals provided to employees at a business party or a business event where you're taking your rank and file employees and you're providing them a meal as part of the event. So, can't just be the officers of the business. This is for rank and file employees. 100% deductible because think about it, you've got everyone in one place. They've got to eat. You're requiring them to be there as part of the event. This falls under the 100% rule. Food that you provide to the general public. So, like you're at a marketing event and you've bought food for people and anyone can take some of it, 100% deductible. Think of it almost more like a marketing expense in this case. Um, Expenses treated as compensation or reimbursed under a non accountable plan. We were talking about one slide ago. So, this is 100% deductible to you, but kind of a bummer for your employees because now you have to include it as income on their W-2. So you give them meals, but they're really paying for it. So that's why you get the deduction. Then expenses billed to others. So if you're taking a vendor out, given the example we did earlier, but then you bill them or something, or you bill a client for the meal that you purchased, 100% deductible because someone else is getting that 50% deduction. So it's just you're just moving the onus from one person to the other. So those are the key examples of the 100% deduction. So same thing, I'm going to run through these really quick because we're pushing up on time here. But so say taxpayer E provides meals to its employees as a fringe benefit. They have to include that as income on the employee's W-2. Same thing, the example of a subcontractor. They say you buy food for the subcontractors, they're working on a job, and then you turn around and you bill the subcontractors for that food. So you get 100% deduction. It's also going to wash because within that bill, you're claiming income, right? So it's essentially a wash. Then the subcontractor gets 50% meal expense. Same thing, holiday staff party, 100% deductible. So let's talk about the most important thing, and that's how do you actually substantiate these meals so that they are deductible and you're protected in the case of an audit. Um, we've actually built a checklist out. It's available for you to download. I will leave a link down in the description of this video or on any post we've placed this out. And it's a free business checklist. You can get it today, no problem. One thing I will say is just as you're going through and you're actually having these meals and if you're going to go through the exercise of filling out the checklist and having it as and as can't speak right now, but as a supplement to your substantiation documentation, don't just check the boxes. Remember the facts and circumstances rule. So, what do you need? You need proof of payment. Please keep the receipt. Keep your receipts. It's your point of truth in you spent something for the business. You know, you've got your bank statements too. That's great. But the receipt has itemized detail. It's the truth. It's the source of truth for you. Keep the receipt. You need to know the amount. You have to have the date, the place, the business purpose. Write down who attended and write down the purpose of the meeting. That's going to go a long way in helping someone determine whether or not, under the law, this was a deductible meal. Um, Make sure you were actually at the meal. That's kind of important. It'd be weird to be like, say, on a Zoom meeting and your client has a meal, you've got a meal. Uh, doesn't meet the presence test. So, and of course, it's not lavish or extravagant. You're not going crazy with it, right? It's a normal meal. Um, if there's entertainment included, make sure the meals are separated out from the entertainment portion of things. So it goes back to that ball game example, right? If I buy a viewing box and there's food included with it, make sure those get split out, or you can at least reasonably determine the fair market value of that meal. If you're traveling, there's some extra rules for travel. We won't dive deep into that here, but note the destination, the dates of the travel, the reason for the travel. Again, there's got to be a reason, a legitimate business reason that you traveled to this place. Make sure you note all of that. And also note if there's the 100% deductible exceptions that we talked about, and that will be on the checklist. All right. And just one last point before I jump off here. There was the big change under the One Big Beautiful Bill Act. So meals on company's premises that were for the convenience of the employer starting January 1st, 2026, these are now non-deductible. So if you are a business owner that offers this, plan accordingly. Reach out to your tax professional to see if you can structure it in a different way. Um, that's legitimate, and there are certain workarounds under different sections of the code, different ways you can structure things, but overall just understand that at a high level this is now non-deductible. So sounds like a lot that was drinking from the fire hose. I know if there's the biggest takeaways I can give you from this is don't trust everything you hear on social media, because people are looking at it through rose tinted glasses. And there's a lot of promoters and gurus out there that will sell you tax strategies that are not legitimate, not based in law, and could get you in a lot of trouble down the road. Remember, the IRS has a long memory. You may not get audited this year, but a few years down the road, and when you're having to go back and look at all these things and substantiate them in an audit, you're going to be happy that you put everything together correctly now. So if you don't want to navigate your taxes and accounting alone, reach out to us at High Impact CPA. We're focused on being proactive with our tax strategies and working on your profitability, your cash flow as your outsourced CFO. I will leave, if you want to have a call with us, I will leave a link down in the description as well, and we would love to hear from you. All right. Thanks so much, everybody. Have a great day.